Here is a figure that tells you almost everything about Germany right now. Europe's largest economy is expected to grow by just 0.5% this year. 0.5%. For a country that was once the undisputed engine of the continent, that is barely a flicker of life. And it gets sharper. The Bundesbank, Germany's central bank, says the only reason the economy is not actually shrinking this summer is government spending. Strip out the state's checkbook, and gross domestic product would be falling outright. Welcome to your Germany financial update for Monday the 15th of June 2026. Over the next few minutes, we will walk through the GDP forecasts, the latest inflation numbers, where the DAX stock index stands today, what the European Central Bank is doing with interest rates, and how American tariffs are hitting German factories. No jargon, no spin, just the numbers that matter and what they mean for you. Let's start with the growth picture, because it has just got gloomier. In its June projections, the Bundesbank trimmed its 2026 growth forecast to 0.5%, down from the 0.6% it penciled in back in December. More striking is the downgrade for next year. The bank slashed its 2027 forecast to 0.8%, from a far rosier 1.3%. That is a serious revision in just 6 months. The Paris-based OECD is a touch more optimistic, projecting 0.7% growth this year and 1.1% in 2027, but the message is the same. Germany is stuck in low gear. The Bundesbank described the recovery as one that is only slowly getting started, which is a polite way of saying the economy is crawling rather than striding forward. So if private demand is weak, what is keeping Germany out of recession? The answer is the state. Berlin has unleashed a wave of spending on defense and infrastructure, and that fiscal firepower is doing the heavy lifting. The Bundesbank put it bluntly, saying expansionary fiscal policy will be the only thing preventing a decline in gross domestic product in the summer half-year. This marks a genuine shift in German economic thinking. For decades, the country was famous for its fiscal discipline, the so-called debt brake that kept borrowing tightly capped. Now, faced with security pressures and crumbling roads, bridges, and rail, the government is opening the taps. The trade-off is clear. Public money is plugging the gap left by sluggish consumers and cautious businesses, but it is not a substitute for a genuine, self-sustaining private recovery. Now to prices, and here there is a glimmer of relief. German inflation rose by 2.6% in the year to May 2026. That is an easing from the previous month, when it hit 2.9%, the highest level in 2 years. So the direction of travel in the very latest data is downward, which households will welcome. But zoom out, and the picture is stickier than the European Central Bank would like. The Bundesbank expects overall inflation to average 2.9% across the whole of this year, before slipping to 2.7% in 2027. Both figures sit above the ECB's 2% target. In other words, the cost of living in Germany is still rising faster than central bankers want, and the squeeze on real incomes has not fully released its grip. One major reason inflation flared up earlier this year sits well beyond Germany's borders. The outbreak of conflict in the Middle East in March 2026 sent fuel prices sharply higher across Europe. Germany, as a major importer of energy, felt that jolt quickly at the petrol pump and in heating bills. Energy inflation became one of the main drivers pushing the headline rate up towards that 2.9% peak in April. This is the uncomfortable lesson Germany keeps relearning. Its industrial powerhouse, built on energy-hungry manufacturing, remains deeply exposed to geopolitical shocks it cannot control. When a conflict thousands of miles away spikes oil prices, German factories, lorries, and households all pay more. It is a structural vulnerability that no amount of domestic policy can fully insulate against, and it complicates the central bank's job enormously. What does all this mean for ordinary workers? The labor market is feeling the strain. In May 2026, roughly 2.95 million people were unemployed across Germany, pushing the jobless rate to 6.3%. For a country long accustomed to near full employment and chronic skilled labor shortages, that is a notable softening. The weakness is concentrated in industry, where manufacturers facing weak orders and high costs have been slow to hire and quick to trim. The flip side is that an unemployment rate of 6.3% is still moderate by historical and European standards, and the deep labor shortages in healthcare, engineering, and skilled trades have not vanished. But the trend matters. A rising jobless count signals that businesses remain nervous about the future, and nervous businesses do not invest or expand. Let's turn to the stock market, because the DAX tells a surprisingly upbeat story against this gloomy economic backdrop. Germany's flagship index, made up of 40 of the country's biggest listed companies, was trading around 24,700 points in early June 2026. That represents a remarkable recovery. Back in April, the DAX had slumped to a low near 21,500, hammered by the initial shock of American tariff announcements. Since then, it has clawed back the losses and pushed towards new highs. Why the disconnect between a struggling economy and a buoyant market? Because the DAX is packed with global giants, companies that earn much of their revenue abroad, not just at home. So while German consumers feel the pinch, multinational exporters listed in Frankfurt can still thrive on demand from around the world. Behind every market move sits the European Central Bank, and right now it is holding its nerve. After a series of rate cuts, the ECB has settled into what economists call neutral territory, with its key policy rate sitting at around 2%. The expectation among analysts is that rates will stay roughly where they are throughout 2026, with no further cuts on the immediate horizon and the next move potentially being a hike, possibly not until the middle of 2027. For German borrowers, that means mortgage and business loan costs have stabilized after the turbulence of recent years, but cheap money is not coming back anytime soon. For savers, it offers modest returns. The ECB is essentially waiting, watching inflation, watching growth, and trying not to choke off a fragile recovery while keeping prices in check. Now we come to the single biggest external headache for German industry, and that is American trade policy. Under a revised trade agreement reached last August, the United States imposed a 15% baseline tariff on European goods, including a 15% levy on car imports. For an export champion like Germany, that is a direct blow to the bottom line. The damage is already visible in the data. German car exports to the United States fell by nearly 15% across the first 3 quarters of 2025. Overall, German exports to America have dropped by around 7.8% over the past year, with machinery, chemicals, and industrial components all feeling the pressure alongside the carmakers. Germany built its prosperity on selling precision-engineered goods to the world, and a wall of tariffs around its biggest single export market strikes at the very heart of that model. As if tariffs were not enough, German exporters face a second, quieter headwind, and it is the strength of their own currency. The euro has appreciated sharply against the US dollar over the past year. On paper that might sound like a sign of strength, but for an export-driven economy it is a genuine problem. A stronger euro makes German cars, machines, and chemicals more expensive for overseas buyers, eroding the competitiveness that Germany depends on. There is a second sting too. When globally exposed German companies convert their dollar earnings back into euros, a stronger euro shrinks those profits in the accounts. So the currency delivers a double hit, denting both sales volumes abroad and the value of foreign income at home. Combined with American tariffs, it leaves German industry squeezed on 2 fronts at once. So where does the market go from here? Despite all these headwinds, analysts remain cautiously optimistic about German equities. Forecasters point to the DAX potentially reaching around 27,500 points by the end of next year, which would represent a healthy double-digit advance from current levels. The bullish case rests on a few pillars. First, the resilience of those global earnings we mentioned. Second, the prospect of stable, predictable interest rates from the ECB, which markets love. And third, the wave of government spending on defense and infrastructure, which channels real money into German industrial firms, construction companies, and engineering groups. It is a reminder that the stock market and the economy are not the same thing. A sluggish GDP figure can coexist with a rising index, especially when state spending and global demand do the lifting. So let's pull it all together. As of mid-June 2026, Germany is an economy walking a tightrope. Growth is barely positive at 0.5%, propped up almost entirely by government spending on defense and infrastructure. Inflation is easing but still stubborn at 2.6%, above target. Unemployment has crept up to 6.3%. American tariffs and a strong euro are squeezing the exporters that built the nation's wealth. And yet, the DAX has recovered to near record highs, buoyed by global earnings and the promise of steady interest rates. The big question for the months ahead is simple. Can government spending bridge the gap long enough for genuine private demand to recover, or is Germany merely papering over deeper cracks? Keep watching the data, because the answer will shape the whole of Europe. Thanks for joining me, and stay informed.